All right, let's go ahead and get started. Thank you all very much for joining me today. Happy Friday. Welcome aboard to our weekly Outlook webinar. This is Ilian Yotov, Forex strategist and founder of allthingsforex.com. I'd like to invite you also to listen to my daily program, All Things Forex broadcast, available on my website, which, by the way, is going through a major remodeling, and it is down at this moment. Hopefully by next week, Tuesday or so, after the Memorial Day holiday on Monday, we're going to roll out the new website, and you're more than welcome to come and join me and check it out for yourself. It will have a lot better look and a lot better user experience, and some interesting new things there that you can check out. Monday through Friday on allthingsforex.com, you can listen to my daily All Things Forex broadcast, which is an outlook on and analysis of the current events on the currency market. So without further ado, I wanted to also thank our friends at fxstreet.com for putting together the series of weekly Outlook webinars. And what we're here today is to prepare for the new trading week, which is the final trading week of the month of May. Another potentially tumultuous and busy trading week is ahead of us, and you will see shortly, you will see why I'm using the word tumultuous. It is filled with important economic data from both sides of the Atlantic, from the United States and from the Eurozone, as well as some geopolitical events that could, of course, impact the direction of both of these main currencies, the US dollar and the euro. The very first of the top 10 spotlight events for next week I have chosen to be the U.S. Consumer Confidence Index. Now, many of you know the conference board does a survey and puts together an index of consumers' sentiment. And so far, the U.S. economic data in the last couple of months has not been as strong as it has been in the first quarter of 2012. Now, this is something that is concerning, obviously, because if U.S. economic conditions were to continue deteriorating, especially in the weeks leading to the Federal Reserve's interest rate next monetary policy meeting and interest rate announcement is scheduled for June the 19th and June the 20th. So in the days and weeks ahead of that Federal Reserve meeting, it's going to be crucial for the U.S. economic data to show signs of resilience. If that is not the case, then if U.S. economic data weakens and starts showing signs that the economic conditions are deteriorating, then that would increase exponentially the market's expectations that the Fed will be forced into doing more quantitative easing, or the so-called QE number 3, which I have been saying for many, many months on this program, that it will weigh on the U.S. dollar. Obviously, it will be liked, a decision from the Fed to do QE number 3 will be liked by the equity markets because it stimulates the economy. But we know as currency traders that that stimulation of the economy is going to be done at the expense of the U.S. dollar. All you have to do is go back in time in the last couple of years and see what QE number 1 and QE number 2 have done. So this is the importance of paying close attention to the U.S. economic data, making sure that U.S. economic data still shows signs that the economy is resilient despite of what is going on in the Eurozone, which is recession, economic slowdown, geopolitical developments there that increase the risk, uncertainty, market jitters, and so forth and so on, about Greece potentially exiting the Eurozone, about Spain, especially today now, a little reminder that it's not only Greece that has the problems. The region of Catalonia and the Catalan president there repeating his call for the Spanish government to help the region to access funding. And obviously this is the largest, one of the largest region there in Spain. So Spain continues to be a problem. The banks there continue to be a problem. Borrowing costs rising is also a significant problem for the euro as well, as we have explained, and I've explained many times before. If borrowing costs for debt-ridden nations, troubled nations continue to rise, then ultimately the debt will be unmanageable. It will be practically impossible to even pay the interest on such debt with rising borrowing costs. And this is something that after breaching the so-called breaking point, which is estimated around 7%. So what I was talking about is that there's going to be a lot of economic reports coming out from both the United States and the Eurozone, and this is why the euro-dollar currency pair is going to be, once again, in my opinion, retain its center stage spot, because it's been in the center stage of the market's attention for at least the last 3 weeks, especially after the elections that we witnessed on May the 6th from Greece and from France, showing the change in political landscape in both of these countries, and market uncertainty and jitters have obviously increased. And the rest is history. You know that the euro's come under pressure. But what I was explaining earlier is that ahead of the Federal Reserve's interest rate meeting and announcement on June the 19th and 20th, if the U.S. economic data starts showing signs of weakness, then that would raise the expectations that the Fed could announce another round of quantitative easing. It was actually Goldman Sachs chief economist who came out a couple of weeks ago, and I mentioned that in our program last week as well. Okay, so as I was mentioning earlier, another report that we're going to focus on is the Italian bond auction, which is coming up on Wednesday. Now, that's not an economic report, but I explained the importance of it, because obviously the market is focused on what's going on with these troubled nations in the Eurozone, and Italy certainly is one of them, has a heavy debt load, and in recent weeks, with the increase in uncertainty about the future of Greece and whether it will stay or it will exit the Eurozone, everyone's paying attention to the latest polls from Italy showing the far-left party there, Syriza, gaining the majority of the votes. Now, that's just the polls, obviously. It's not the official outcome of the election, which is scheduled for June the 17th, but the polls are definitely going to impact investor sentiment going forward throughout the next few weeks ahead of the June 17th election from Greece. And along with that, we're going to continue to watch if borrowing costs are on the rise again. The implications of which I also explained a little bit earlier, that ultimately if they start reaching and then breaking above the so-called breaking point, then things could get even worse than they are in the Eurozone. And it could really sour investor sentiment further, and ultimately it could only escalate an already escalated crisis, if you will, and could put additional pressure on the single currency, the euro. So the Italian bond auction is a 10-year auction. 10-year government bonds are going to be auctioned by Italy. In many countries, industrialized nations, the 10-year bonds are the benchmark security or bonds that governments issue. The moves in the rate, in the yields, and so forth and so on of 10-year bonds is very closely watched. And that's the type of auction that's coming up on Wednesday. Then we are going to see another important economic report from the United States from the housing market. It's a leading indicator of housing market activity with the U.S. pending home sales index, which is a leading indicator. It measures contracts, the number of contracts signed for home sales. The pending home sales increased by 4.1% in the month of March, but for April they're expected to stay unchanged. 0% is the consensus forecast in a pending home sales index, which is not going to be a very positive report from the U.S. housing market. So this could be one of the weak spots in the economic data from the United States throughout next week. And once again, as I said earlier, that could raise the market's expectations for the Fed to do more quantitative easing, to be forced into doing more quantitative easing. Now, I want to take us to the daily chart of the euro-dollar pair to see the latest trend developments there with the euro-dollar exchange rate. As many of you know, let me reduce the size of the screen a little bit. As many of you know, the euro recently broke below a very important price level, which is $1.30 level. It was $1.30 also served as the bottom of an existing range where the euro-dollar exchange rate was somewhat comfortably trading within a range between roughly $1.30 and $1.35. The implications of this bearish breakout for the euro versus the dollar below the $1.30 I explained weeks ago. And I said that this time around, the situation and the developments were different compared with the previous attempts to break below the $1.30 level. And I gave you the three examples in the last several months when the euro tested the $1.30 level, but never decisively broke below it. Here's the first, the second, and the third attempt. This time, on a fourth attempt, it was quite different. It actually led to a decisive breakout below the $1.30 level. Obviously, the market jitters accelerated and uncertainty increased. The market anxiety levels and put pressure on the euro. The euro managed to move to complete the first large quarter of 250 pips. Very important development. As I explained weeks ago, that is not only a break below $1.30, it is also, in terms of my quarters theory methodology, a transition of the euro-dollar exchange rate from the current 1,000 pip range into a new 1,000 pip range. Now, those of you who didn't listen to the program a few weeks ago when the euro was breaking below $1.30, let me refresh your memory, let me explain. In my quarters theory, and that is the only place in the world that you're going to hear anybody talking about this, it's me who talks about these things. There is an important development, an important shift that is occurring with the euro-dollar exchange rate. And that is what I call the phenomenon of this, what I name in my quarters theory, the 1,000 pip range transition. Meaning that the euro-dollar pair is transitioning its exchange rate from the $1.30's 1,000 pip range, between $1.30 and $1.40, into a brand new 1,000 pip range of $1.20, between $1.20 and $1.30. And I gave you, as I normally do when these 1,000 pip range transitions begin, I told you the factors to watch for that will give us a clue as to whether or not the 1,000 pip range transition is successful or not. And the implications of us being able to recognize a successful 1,000 pip range transition is that we can prepare for further advancement of currency pair exchange rate into that new 1,000 pip range. That is the implication of a trader being capable, being able, knowledgeable when it comes to these 1,000 pip range transitions. And it's very important to know what to look for. And I told you a few weeks ago what we should look for. As I explained in my book, The Quarters Theory, the first requirement that I have in order to give us an idea as to whether or not this will be a potentially successful 1,000 pip range transition is that the first requirement is the first quarter of 250 pips of a new 1,000 pip range must be completed successfully. In other words, if the euro is dropping below $1.30, it is beginning to transition from the $1.30 into the $1.20. So the first large quarter of 250 pips of the $1.20's 1,000 pip range would be the 250 pip large quarter between $1.30 and $1.2750. For those of you who are now scratching your heads and going, what in the world is this guy talking about? Large quarters, 1,000 pip ranges. Let me explain. With my quarters theory, I propose that currency exchange rates fluctuations and price fluctuations in general are not chaotic and that are not random. I propose that there is a organization in the moves and fluctuations of currency exchange rates and prices in general. So I look at the 1,000 pip ranges, or the ranges of 10 cents between what I call major whole numbers, such as $1.30 and $1.40, or $1.20 and $1.30. In terms of pips or price interest points, each 10-cent range between these two whole numbers gives you a clearly established constant range of 1,000 pips. So, with my quarters theory, I divide these 1,000 pip ranges into 4 equal parts, or 4 large quarters of 250 pips each. And I propose that exchange rates and prices in general fluctuate within these 1,000 pip ranges in organized, systematic manner from one large quarter point targeting another large quarter point. And when the euro-dollar pair, for example, starts breaking below $1.30 level, then it begins to work on a large quarter between $1.30 and $1.2750. That's the next large quarter point below $1.30 that we are monitoring. And as I was explaining earlier, if you're paying attention to that 1,000 pip range transition, it's very important to see as a first sign of a successful 1,000 pip range transition, the first large quarter of a new 1,000 pip range being completed. Indeed, the euro-dollar pair did exactly that. Literally in a matter of days, a couple of days after it broke below $1.30, it has already completed the quarter to $1.2750 right there on May the 15th. That quarter was already completed. But that is not enough to see a completion of the first large quarter of a 1,000 pip range. The second requirement that I have is that on a pullback, because pullbacks and retracements are going to occur, prices do not always go up and do not always go down, as you already know. There's going to be pullbacks, there's going to be price corrections. When such price correction occurs, then on the pullback that would take prices in a direction back towards the preceding major large quarter point, such as the $1.30 level, we do not want prices to go back into the previous 1,000 pip range. In other words, after the euro-dollar pair has completed the quarter to $1.2750 large quarter point from $1.30 to $1.2750, on the pullback that takes prices back towards the $1.30 level, we do not want to see the euro-dollar pair price going above $1.30, going back into the $1.30's 1,000 pip range. That would not be a sign that the 1,000 pip range transition is success. However, on a recent pullback, where the euro retraced back from around $1.26.5 to a little bit above $1.28, $1.28.18 on May the 22nd, prices did not climb back above the $1.30 level. So that was the second requirement that was met successfully. And at that point, we can recognize the signs that both of the requirements for a successful 1,000 pip range transition were met. What I was explaining weeks ago, when a trader is able to recognize these signs of a successful 1,000 pip range transition, a trader can prepare then that prices could make further advancement into that new 1,000 pip range. In other words, prices could continue, the euro-dollar exchange rate could continue to drop deeper into the $1.20's 1,000 pip range, more than likely challenging the major half point, as I said weeks ago, of the new 1,000 pip range, which is the $1.20 level. Well, anyone who's paid attention to the euro-dollar developments in the last couple of days pretty much have seen the $1.25 level being targeted. Yesterday we had a low at the $1.25.14, 14 pips above $1.25. Today we're overshooting below the $1.25 large quarter point with an intraday low at the $1.24.94. As I was warning you a few weeks ago, the break below $1.30 did occur. It was different than the previous 3 times. It was identical, similar development that could open the door to another possible significant leg lower for the euro-dollar exchange rate, and I gave it the historical examples from last year with the 2 strong legs down after a price correction. We had the first leg down here, significant price correction, another significant leg down, price correction, a little fluctuation within a range, break below the bottom of the range, opening the door for another significant leg lower for the euro-dollar exchange right now. Of course, many are questioning, okay, so we moved to $1.25. Is there further weakness to come? Well, of course, that would be dependent on, if I might say, which way the risk aversion winds are going to blow. If we get to see some fantastic news all of a sudden out of the Eurozone that there's going to be some bold measures that are being proposed, which I'm highly doubtful that this would be the case, at least the last 2.5 years since the European debt crisis began, have not shown us that the European Union leaders are capable of making the call for such bold decisions, bold announcements, bold measures. But hey, never say never. Better late than never for them to wake up and come up with some bold solutions there that create economic growth, to stimulate the economy. That is very necessary, by the way, for the European Union to avoid, to contain this crisis. Now, after the European Union summit earlier this week, many leaders are once again promising that at the next summit, one thing also that we've learned in the last couple of 2.5 years is that the European Union leaders may not be very capable of coming up with some bold solutions, but they are very capable of promising things. That something bold is going to, something important, something really big is going to come in the future. Now that is something that they're capable of, promises. And so now we have this promise that at the next European Union summit, which is going to be on June 28th, if I'm not mistaken, there's going to be these huge, bold solutions that are going to miraculously create economic growth in the region, and these promises that we have heard for the last 2.5 years. Now, you know, if the market likes these promises, then obviously the euro could bounce a little bit higher. It is due for a more significant price correction anyway. It has a significant drop here. I mean, especially down here when you see the euro going down for, what was it, like 8 or 9 consecutive trading sessions, you really don't need to look at the latest and the greatest technical indicator to figure out that the conditions are oversold. But that is not an indication that the trend is over with. It could lead to a temporary price correction, obviously, as it did for a couple of days here, where the euro bounced a little bit higher. But with the euro staying within that trend pattern, did not break above $1.30, if you were monitoring these signs of the 1,000 pip range transition and following my requirements, you would have more than likely known that there's further downside to come. And so this could be the case. Again, the euro could correct a little bit, could bounce, especially once it reaches $1.25 level, which is an important large quarter point. You also have an important support level, by the way, which, let's say here, it was, there's a support level, let me see here. I'm trying to condense this chart here so we can go back to 2011, 2010 levels. I mean, you can see some support levels being at around the $1.25 area, which are being tested as we speak right now. But it looks like if we break below $1.25 level, the next level, of course, is the large quarter point, $1.2250. You can see that congestion around this area that occurred in 2010. A little bit below $1.2250, we have $1.21.5 level, serving as a level of support from June the 29th. And then $1.20, if that major large quarter point is reached, the euro would complete the entire 1,000 pip range between $1.30 and $1.20, which I would not be shocked to actually see if conditions continue to deteriorate right there and Greece gets one step closer to an exit from the Eurozone. So obviously, there is a potential for further euro weakness, but also don't be surprised if QE number 3 expectations with the Fed interest rate announcement coming up on June the 20th, if the market starts pricing in such expectations and the U.S. economic data weakens, then that could weigh on the U.S. dollar and could cap the further U.S. dollar gains. On top of that, and I wrote this in my outlook last weekend, we should not exclude the possibility as a factor that could weigh on the U.S. dollar going forward. The potential for another debt debacle, the debt ceiling debacle. Remember that last year? How detrimental that was for the U.S. dollar strength, with the Treasury Secretary, Timothy Geithner, last week, coming out and saying that the U.S. government is going to run out of funds before its estimated date for an increase in the debt ceiling, which is in 2013. The debt ceiling was scheduled to be increased here in the United States in 2013, conveniently after the presidential election in November. However, the Treasury Secretary last week admitted that the United States will once again hit the debt ceiling limit before its next scheduled increase in early 2013. The warning from the Treasury Secretary, to me, means that we could be faced with another debt ceiling debacle, which this time will be happening not in 2011, which was not an election year. It will happen this year some point potentially, which is an election year, which could only raise the anxiety levels of an already shaky market. And what we have seen with the debacle last year, obviously that could be a major factor that spooks investors' confidence. And it could weigh on the U.S. dollar. By the way, with the whole debt ceiling debacle last year, many of you would recall, in the last minute, after weeks of political theater in Washington, the U.S. government finally decided to raise the debt ceiling in 2011. It helped the U.S. government avoid a default, but led to the United States, for the first time ever in its history, to lose its AAA credit rating. So be aware of the potential for this to be a major drag on the U.S. dollar if we get to see another showdown on the debt ceiling similar to the one we saw in 2011. Now, moving forward with the top 10 spotlight economic events for next week. The next important economic event, or geopolitical event rather, from the Eurozone is scheduled for Thursday, May 31st. It's going to be an all-day event with the Irish referendum on the newly proposed, I believe it was in March or February or March, the so-called European Fiscal Treaty, or European Stability Treaty or Pact, Fiscal Pact. So the voters in Ireland are going to vote on a referendum to whether reject or accept the European Union's Stability Treaty. And the Fiscal Stability Treaty referendum is happening in Ireland next Thursday. More than likely, they're going to vote for it. But again, it's another event that could increase market jitters and uncertainty. To add to all of the uncertainties surrounding Greece and the situation in Spain. So another event there to watch that could increase market anxiety levels, and it could weigh also on the single currency, on the euro. And vice versa. Of course, if the outcome of the referendum is positive, maybe the euro could see a little bit of a respite and a bounce a little bit higher to correct some of its recent losses versus the U.S. dollar. Another major event next week is going to be the Swiss Gross Domestic Product Report on Thursday morning, 1:45 a.m. Eastern Time. Many of you know the Gross Domestic Product Reports are the main measure of economic activity and growth. Yesterday, a little bit of news. Finally, we saw the euro-Swiss franc currency pair waking up on some rumors that the Swiss National Bank is considering to start taxing deposits held in Swiss francs. This is all a rumor, of course. It hasn't been confirmed officially. We know that the Swiss National Bank has established a floor for the Euro-Swiss franc exchange rate since last September. It's a historic decision, second time ever in the history of the Swiss National Bank that they have resorted to use such extraordinary measure. But we know also that the dollar at the 1.20 level for the Euro-Swiss exchange rate has been tested many times in recent weeks, especially that we had the European debt crisis escalating, and more than likely could continue to be tested if conditions continue to deteriorate in the Eurozone, and if the Euro is being put under pressure against a variety of major currencies, including the Swiss franc. So it would not be unusual, it would not be unexpected for us to see the Swiss National Bank becoming more creative rather than just spending billions and billions to defend the 1.20 ceiling for the Swiss franc and a floor for the euro. If they come up with some more creative measures, which I've months ago said that I wouldn't be surprised if they consider increasing or raising the floor for the Euro-Swiss exchange rate. And my number is about 1.30. 130, from 120 to 130. But another measure, according to the rumor yesterday, is that the Swiss National Bank might consider charging tax on Swiss franc holdings, deposits. So it's not unusual. They have done it, by the way, and last night I went and did a little research, and they have done something like that before, in the late 70s, early 80s. Nothing new under the sun. So it's another measure there that, combined with the floor at 1.20, will be designed to cause further weakening of the Swiss franc, which, by the way, the Swiss National Bank, every time they speak, they remind the markets that even at 1.20 versus the euro, they still feel that the Swiss franc is overvalued. Now, the Swiss GDP report next week could be a factor that speeds things up. And what I mean by that is that it could be a factor that prompts the Swiss National Bank into additional action sooner rather than later. The Swiss gross domestic product is expected to show 0% economic growth in the first quarter of 2012, compared with 0.1% quarter-over-quarter growth in the fourth quarter of 2011, which is in line with what we saw from the Eurozone gross domestic product last week. 0% flat. No growth on a quarter-over-quarter basis. The lack of economic growth in Switzerland in the first quarter of 2012 could be a factor for the Swiss National Bank to consider additional measures to weaken its currency, the Swiss franc. And that report is due at 1:45 a.m. Eastern Time, in my opinion, on Thursday, next Thursday, May 31st. In my opinion, an important report that could make things interesting again when it comes to the Swiss franc exchange rate. And this report on May 31st is coming up 2 weeks before the next interest rate monetary policy assessment, which is due on June the 14th from the Swiss National Bank. So it should be interesting few weeks also when it comes to the Swiss exchange rate, especially versus the euro. And the US dollar, by the way, because the Swiss franc is actually weakening, as you may have seen, breaking above certain resistance levels there. The dollar is breaking above significant resistance levels versus the Swiss franc. Another important report next Thursday, the Eurozone Flash Harmonized Index of Consumer Prices. Many of you know this is the main measure of inflation in the Eurozone. By the way, the flash estimate for the month of May is expected to show inflationary pressure subsiding in the Eurozone from 2.6% to 2.5% year over year. That is important because, as I've explained many times before, it creates a more comfortable environment for the European Central Bank to consider further easing, something that they refrained from doing at their meeting in early May, However, as I explained at that time, do not be fooled. They still more than likely will be forced into considering more quantitative easing or bond buying or another round of long-term refinancing operation or some other creative options there to stimulate economic growth. And that is the key as far as the current situation in the Eurozone. Growth, growth, growth. That is why you see the European leaders focusing and talking about growth a lot more recently, and rightfully so. And that report is coming up at 5 a.m. Eastern Time on Thursday morning, and it's going to be followed by the Automatic Data Processing Employment Report, which many of you know it's a measure of job creation, measures private sector payrolls. The ADP Employment Report is expected to show, and that usually that comes on Wednesdays, a couple of days before a non-farm payrolls report on Friday. But because of the Memorial Day holiday here on Monday of next week here in the United States, that report has been pushed a day from Wednesday to Thursday. It will be released on Thursday next week, one day before the non-farm payrolls report on Friday. But we're expecting a little bit better private sector job creation from 119,000 in a month of April, which was lower than a consensus forecast, by the way. We saw a couple of disappointing non-farm payrolls reports, as many of you will recall, in early April and early May. So March and April job creation was not strong at all. It's one of the weak economic reports that we discussed in recent months that would raise the potential for the Fed doing more quantitative easing. Now the ADP private sector employment change is expected to show private sector payrolls increasing to 139,000 from 119,000. So it would be better than the previous month. Then at only 15 minutes after the ADP report, we're going to see the U.S. gross domestic product, which is the main measure of economic activity and growth here in the United States. As many of you know, the growth in the United States was lower in the first quarter of 2012, something that I've been warning about for months before that report was released in April. For the first quarter, the preliminary estimates showed the U.S. economy growing by 2.2% in the first quarter of 2012 compared with 3% in 2014, so slower economic growth. The impact of this report next week could be negative on the U.S. dollar, and the reason why I'm saying that is because the consensus forecasts are pointing to a downward revision for the preliminary estimate. The preliminary estimate last month showed 2.2% growth. The consensus forecast is expecting a downward revision to 1.9% growth in the U.S. economy, which, by the way, is something that I was also talking about because a Moody's indicator by Moody's was estimating that the first quarter growth in the United States was 1.8%. So it would hardly be surprising to see even slower economic growth in the U.S. in the first quarter of 2012. But along with that, if that is the outcome of this report, this could weigh on the U.S. dollar on Thursday, that downward revision, because it also raises the odds for the Fed announcing more quantitative easing, if not in June, possibly in the second half of 2012, which has been my estimate, by the way, as well, that in the second half of 2012, the Fed could announce further stimulus and more quantitative easing. Now, this report is going to be followed on Friday by the main event next week, and that's the non-farm payrolls employment situation report. Many of you know that, as I mentioned earlier, April and May employment reports have not been strong. They've shown the U.S. economy actually creating a lesser amount of jobs. We saw a little bit of a pullback in the unemployment rate to 8.1%, which is not too shabby. But the problem is that we're seeing slower, smaller job creation in the U.S. economy. The consensus forecast, of course, if this is another disappointing third in a row, if we get to see on June 1st next Friday, another disappointing, weaker than expected non-farm payrolls report and weaker than expected job creation, this would be 3 negative non-farm payrolls reports in a row. And at that point, it becomes a trend. As I explained previously, the Fed will pay close attention to these reports, especially the ones that come from the labor market. As many of you know, the Fed has a dual mandate, not only to maintain and assure price stability and control inflation, but also to create the conditions for maximum employment. That's the dual mandate of the Federal Reserve here in the United States. And this is why the employment reports, and this is the main measure of the condition of the U.S. labor market, is going to be so crucial next Friday. Now, if this is another disappointing employment report, the dollar could stay under pressure for 2 days after the GDP downward revision on Thursday, if that is the case, of course, if the GDP is revised lower, and then another weaker than expected non-farm payrolls report. That's 2 days of potential pressures increasing on the U.S. dollar. If, however, the non-farm payrolls reports are more upbeat, and by the way, that is what the consensus forecasts are expecting, a little bit more upbeat employment report next Friday, with the unemployment rate staying at the 8.1% level and the U.S. economy creating anywhere from 150,000 to 170,000 new jobs, which would be stronger jobs creation than the 115 jobs that were created in April. So anywhere from 150 to 170,000 jobs is the consensus forecast range for a non-farm payrolls report next Friday. So we'll definitely pay close attention to that report. And then another important U.S. economic data is going to wrap up the busy trading week next week with the Institute for Supply Management Manufacturing Purchasing Managers Index. And that report is also expected to show the manufacturing sector of the United States expanding for another month with a reading of 54.1, which is a little bit lower than 54.8 in April. But again, the reading above 50 indicates economic expansion. Reading below 50 indicates economic contraction. As long as the ISM index is above 50, that's another month of expansion in the U.S. manufacturing sector. And by the way, the similar report, the Manufacturing Purchasing Managers Index, is going to come at 4 a.m. Eastern Time on Friday, June 1st, from the Eurozone, which is the final manufacturing index. A couple of weeks ago, we saw the preliminary flash estimate, which showed that the manufacturing index there was significantly below 50 in contraction territory. Reading of 45 is what we saw with the preliminary estimate a couple of weeks ago. The final reading is next Friday at 4 a.m. Eastern Time, showing us the same reading as the consensus forecast, a reading of 45. So it will be a great opportunity on Friday morning to compare conditions in both of these large economies, manufacturing sectors, with the U.S. manufacturing growing for another month with a reading above 50, while the Eurozone manufacturing sector contracting for another month in the month of May with a reading, or April, with a reading of 45. So make sure to tune in to my All Things Forex broadcast Monday through Friday. Actually, Tuesday to Friday next week, because Monday is a holiday here in the United States. But I invite you to listen to my program and check out the new remodeled allthingsforex.com. Next Tuesday, we should have it launched with a better version next week. You can listen daily at my program on allthingsforex.com, or you can also follow us on Twitter at allthingsforex, is the Twitter account at allthingsforex. With that said, thank you very much for joining me today and attending this webinar. Have a great afternoon and a great weekend, and I will see you again next Friday. Is non-farm payrolls Friday, so we're not going to have the webinar. The Friday after next, we will continue with the weekly Outlook webinars. Thank you all for attending the webinar today. Have a great weekend, and I will see you a couple of weeks from now.